by going into these things, we will serve the certain pockets of urban India beautifully, but we won't serve the entire part of India.
Navneet, what's your take? As a fund house, would you all be interested in, you know, walking towards the path of being a solutions provider as opposed to, let's say, just being a products provider? I mean, how are you using technology to solve this problem of asset allocation?
So that's the trend globally. So whether you call it family solutions or variety of things to do the allocation for the investor, but it's more about complementing or supplementing what the advisor is doing. You can't completely, do away with the advisor and the AMC can do it everything for all the investors would be very, very tough. Also in terms of, I keep giving this analogy of pharmaceutical manufacturer, doctor and the patient. And I think I can't keep changing, every antibiotic that I have. I can't keep changing the, ingredients of that depending on the season or depending on what's happening in the weather or whatever. But I think that's the job of the doctor, right? I mean, our job should be we produce the right kind of formulations, and then he can choose according to what really the patient needs.
Vishal, as a traditional advisor, of course, you've morphed into an RIA now, obviously. But as Sanjeev was saying, technology is coming in. Is it a challenge for traditional advisors such as yourselves, or are you also merging technology into your scheme of things when it comes to navigating these complex markets?
So our view is actually you need to go back to what the client is really seeking and what the investor need is. So we think that there's a certain part of the investor need which technology can solve. And I think as an advisor, we need to pick those components. So what are those components? Those components are, efficiency in transaction. These components are how can you take a lot of data and process it much faster using technology? How can you remove emotions in certain aspects as far as the investing behavior is concerned? I think those are areas where technology is a great beneficiary for traditional advisors. And then you go back to asking yourself saying, what does an investor really need, which has actually a human interface which is critical. And those are about cold definition. I think, when you go onto a platform and ask yourself saying, I want to fund in education, the question is, where's that education? When is that going to happen? How much does it cost? How do you want to fund it? Do you want to take a scholarship? Do you want to take a loan? How much is inflation? Rather than, it's just someone picking that number is 5%, 8%, 12%, whatever he wants. How do you help him understand the process of saying, this is what historical data shows you? So I think the whole contextuality is where the human interface comes in. And that's got huge, huge benefits. So we think that as a traditional advisor, technology is going to help us get better with, interface with clients. It's going to enable us to actually deliver better quality advice. But I'd be surprised if, the entire population is actually going to move to a model where they just prefer to interact with machines to get outcomes. Especially deeper outcomes where a lot of times, they want to talk to someone they trust. We'll give you a few examples. So we live in a space where we think corporate careers are getting shortened. We used to read about this earlier. I think we're now able to see it in our practice where a lot of people who are beyond 45, once they lose their jobs, don't actually get it back. So imagine your retirement is actually moved from being 58 to 45 or 48. Now the question is, what do you do in your life? The first part of it is machines aren't going to solve that for you because you go into a brain freeze zone. You don't know what to do because this was not what you expected when you started off. So you first need human interface to come in there, talk to someone, open up saying that, this might well be the situation. There are spouses in here. They have their own emotions. The way you've spoken about all of this is very challenging. So I think there's a whole process which happens before you get down to saying, okay, so this is how your portfolio needs to change as a result of this. And I think when you get to that, this is how the portfolio needs to change. That's where technology can come in and make it very efficient. But the first part is much, much more human-driven.
Sharad, do you agree with Vishal? Is technology just an enabler, or can technology actually get into the field of advisory also?
We are robo-advisors, so I would say yes, it would get into it. Some of the points that he made are quite genuine, that as of now, You can use technology to bring in efficiency, to reduce cost, to bring in similar kind of delivery to all the investors and all the customers that you have. However, some of the leading banks, wealth managers we are working with have started taking strides towards automation of, say, even advice. So you want to capture a huge amount of market, and you want to give all your investors the same quality of advice. How do you do that? You can only do that if that advice is centralized and at large occasions is driven by technology, something like portfolio rebalancing we were discussing. If you have 1,000 RMs with you who go to a customer and then they do the maths behind it, there would be errors. So you need technology. RMs are required to do the relationship management part of it, emotional handling, emotional quotient, those kind of things. So people are already adopting the hybrid approach. Coming to what will happen in future, that's where I have a radically different view. I always wake up with the fear of underestimating what technology can do. And all the mathematics, etc., everything that can happen that is already being done by machines, right? We have two new sciences which are emerging very fast. They're still in their nascent stage, artificial intelligence and virtual reality, right? Maybe 5 years down the line, Kaiser needs an advice. He's depressed about his portfolio tanking 20%. I can, with the help of virtual reality and artificial intelligence, place whatever you think as a financial wizard in front of you, talk to you like a human, and resolve all your doubts and emotions right then and there. It can happen. It can happen in 10 years. It can happen in 5 years. I don't know. But these kind of things will start impacting what we today think is not possible. Think of it. A smartphone, right? We all use touch phones. If you go back to 1999, where we used to have a one-foot Motorola and over and out kind of technology, if at that point in time I would have placed this phone over here, we would be scared, hey, what is this? Right? We never believed that could happen. And technology has always developed at a pace which we think faster than the pace that we think. So I think there's a lot to unfold. And if I had to bet my money, I would bet on the other side of the technology will be able to do. Yeah, there may be a few things which might still be left over, but it will start taking over that.
Okay. So there's one last section that I wanted to discuss with you all. It's about debt funds. Again, speaking as far as 2017-18 smart strategies are concerned. Navneet, let me begin with you. As far as debt funds are concerned, we've had accidents on both the accrual side as well as on the duration side. These are the broad two strategies that debt funds have followed. So we've, if you take the recent cases of credit downgrades that have adversely impacted debt funds, or let's say funds sitting on a longer duration that have been impacted by monetary policy stance as on a particular period. So I'm just wondering whether in 2017-18 or going forward, should we look at debt funds at all, or what if I'm an investor and if I put my money, if I decide asset allocation, my equity is this much and debt is this much, I put all my debt money in, let's say, a bank fixed deposit for 5 years, and then look at mutual funds only for equity investments.
So I mean, should I just put in like one fixed deposit, which is saying like the asset allocation is be all end all, which is not right, because as I said that to achieve your investment objective, you look at several other things, including your, the liquidity preference, your tax aspects, your time horizon, reinvestment risk, the overall risk return trade-off. And because there is one accident, if there is one flight crash of Malaysian Airlines, you don't stop flying, because there's still huge importance of that, and you need to fly. Udbhav, looking at maybe some of the funds that lost money in last 2 or 3 months, still the 1 year return in my dynamic bond fund is double digit. 3 year is double digit. 5 years, 7 year is close to double digit. And we have seen massive, volatility in interest rates. You'll remember 2013 when rates went up 200 basis points. We have seen that kind of volatility. You go back and check the returns of gilt fund in last 7 years. and you'll be surprised positively. And the same thing about the credit. What happens that one incidence, and then suddenly people will say, stop putting money in credit fund, credit is a bad word. But look at last several years on a risk-adjusted basis, I mean, and we have gone through one of the worst credit cycle in our history of our economy for last 20 years. The last bad was probably mid-90s. And despite that, you look at the total AUM of the industry and what's the overall credit cost that you have paid. So I think both on the credit side and duration side, the industry deserves to get a lot more credit than what we have got. Having said that, in terms of overall investment objective, as I made it clear earlier also, then I think investors should be clear in terms of what is the risk that you are taking. I mean, if it's an extremely long-term fund, you're putting money for few months because they have delivered good return in last 1 year, or somebody is telling you that RBI will cut interest rate, and that's why if you have the money is for liquidity management and you're putting in a long-term bond fund, that's not right.
Naren, what do you think? Debt funds, can we avoid debt funds? Can we afford to avoid debt funds, or should it be a part of a portfolio?
I think it should certainly be a part of the portfolio. I think unfortunately in debt people believe that they should get again absolutely linear returns like a fixed deposit. And in equities there are a number of stocks we have bought which have fallen, but not a single person questions that in debt you want 100% that nothing should go wrong. That's not going to happen when you are so large. And today you have more than 10 lakh crores in debt, there can be, but I think as Navneet mentioned, the industry has handled the money exceptionally well. And the way the taxation structure is there in the industry, I believe that logically you should be investing for 3 years. And on a 3 year, and you have products like liquid where you can invest for very short periods of time. So I think with that combination of investing in products like liquid or liquid plus for short periods of time and investing in products, other products with a 3-year view, I think the industry has shown very good returns. And I believe that debt funds have much more role to play, but I think there is a requirement for the advisors and the media to recognize that debt fund is not a fixed deposit. At the same time, the returns that have been given by debt funds is not equal to that of a fixed deposit. It has been much higher. So I think what the equity fund managers or the mutual funds have managed to communicate the volatility in equity, I think the mutual funds, the wealth managers have not been able to successfully explain the volatility problems in fixed income. The fact that if yields go up, prices go down, that itself is a difficult thing for 90% of the customers to understand. So I think there's a lot of requirement of training, a lot of requirement of communication in this area, and I think it will improve over the next 2 to 3 years.
Vishal, I'll hop over straight to you and last this question, because we are running out of time and we want to invite some questions also from the audience. What do you advise your your customers? Because you as an advisor can advise products other than mutual funds. So for debt, do you necessarily look at mutual funds? All the fund managers are looking at you.
Yeah, so we'd say that there's a bunch of products available. There's a set of hold to maturity products that investors can look at, which funds offer as well as are available outside of the fund space. So whether they're deposits, whether they're bonds, tax-free bonds, etc., you can actually buy those and hold to maturity. And the advantage of holding to maturity is people pretty much don't look at them in the same way. So they just classify them in their mind very differently. People don't look at the fact that a tax-free bond yield might have gone up from 580 to 620 over the last few months. But if the mutual fund NAV has actually dropped because everyone's looking at negative returns, they look at it very differently. So I think some of it is about education, like everyone has said, and some of it is also about expectation in terms of classification in the mind of the customer. The second bit is clearly, the tax arbitrage. And I think that's a big thing for people in the highest tax bracket to continue to look at debt funds as long as that exists. It's really the only way that fixed income is able to protect against inflation, or at least partly against inflation. And I think that's a big, big advantage that you get in India, at least today. Last but not the least, we think, on the debt side, on the debt mutual fund side, I think the challenge for the industry has been that they've not necessarily been true to label. And I think that's where the challenge for the industry will come, that, if I'm going to be a short-term debt fund, then I need to define that my duration will not go beyond a certain level. If I'm going to be a liquid fund, or or an ultra short-term fund, I'll try to keep my duration to a certain level, because obviously you don't want to get surprised when interest rates go up and find your ultra short-term fund has actually lost a lot of money. So I think some of it is going to be education, some of it is going to be just sticking to discipline as an advisor and as an investor and also as a manufacturer.
So thank you. That brings us to the end of the discussion, and we can invite some questions from the audience. If anybody wants to ask a question, please identify yourself, the firm that you represent, and you can direct your question to any of the panelists. Anyone?
Hello. A person is retired. He's got fund of 1.5 crores. His age is 64. His monthly expenditure is about 30,000. For maximum safety, how we can invest? He has no other source of any income. He has got fund of 1.5 crores cash. How we can diversify it investment so that he can get easily 30,000 rupees per month?
So I think that information is decent, but it's probably not enough to be able to give true good quality advice. I think a lot of this is actually around aspirations that you have beyond the 30,000 rupees per month. And what I mean by that is, what's your plan if you have an expectation that this money will last you through your retirement? What happens with the surplus? What's your risk tolerance? What's your ability in your retirement to be able to handle periods where things don't go well beyond the 30,000 rupees a month? So I think there's a bunch of other factors that will also go in before you design an investment strategy. Therefore, we typically say that thumbs of rule, using standardized models in terms of giving advice on some of these items is actually where the risks come, because what happens is people will kind of create a bucket on one side and say, whatever you require for retirement, let's put into this bucket, put it into fixed income, let's not worry about it. Obviously there are assumptions there are inflation assumptions, there are healthcare assumptions, there are all kinds of assumptions that we need to make in. And therefore the need for us to define more tightly what we require, as well as be able to monitor that and review that constantly, is actually going to dictate whether we have a good experience or not from an investment perspective.
Hi, my name is Shantanu. I just wanted to know about this robo-advisory. Now, in a robo-advisory, when you're talking about algorithms, dealing with the financial planning and all that, how do you take into account the, emotional quotient of the investor? Because many a times when he's impersonally answering some questions, either he's probably not understood what he wants, there could be certain misleading. How does your robo-advisory platform address these human aspects of advising,
So I think you're probably going to hear two different answers, right? So my answer is that currently robo-advisors don't do this very well. And we all know that, as you said, when you're answering a question at 10 p.m. in the comfort of your home, saying how will you respond to if the market goes down 20%, your answer is going to be very different from what you will actually do when the market goes down 20%. And that's a known fact. Everybody knows this, which is what even today the risk profile questionnaires, etc., don't take into account, is the gap between what you say you will do and what you will actually do. We are all heroes when there is no danger lurking. So I think the real issue happens is that at the time when the crisis strikes, is the advisor there to handhold you, to educate you, to give you that assurance or support in sticking with your decision, right? And a part of that is about actually making you aware of these things a lot better than just a simple question and answer. And as I said, I don't think the robo-advisors today do this very well. We are all learning, we are all trying to put this in place. And I think we are a very long way away from a robo-advisor completely kind of taking on that responsibility or that role. So.
Sharad, a quick response and then we'll end.
Yeah, what he said is absolutely right. We do not handle it. The emotional part of it cannot be handled right now. A couple of things which we do is, for example, when we ask a person what his income bracket is, we also have the KYC data of the customer. So we try to map, depending on when the KYC is done, some kind of extrapolation, try to figure out how much right or wrong the person is saying, because when you ask a person his income profile, again, he's not comfortable sharing it. So we do a bit of these kind of things, but saying that it handles what you are trying to ask for completely, no, that is not there.
Okay, thank you, gentlemen, for a nice lively discussion.
Excuse
Thank
me.
you.
One last question.
Sir, we have run out of time. We need to move on, but the panelists will be around, so you can catch up with them outside. Really sorry. Thank you.
Thank you, panelists and Kaizad, for this engaging discussion.